Good morning, everyone. Thank you so much for attending. I want to apologize in advance. My voice is a little squeaky today, but we will spend some time talking about all of the changes for retailers and service providers in Illinois for 2025. The three biggest changes that we have, I'll just give a very brief overview right now, is that number one, we have capped the retailer's allowance across almost all of the sales taxes that are collected in Illinois. There are also approximately 20,000 business enterprises who will now be required to collect destination-based ROT and register changing locations in order to file. This is due to a definition update in the statute, which we will review. And then finally, the definition of sale at retail has been updated to include short-term and long-term leases. And of course, short-term leases means daily or hourly rentals of tangible personal property. We'll talk about that as well. So let's begin by looking at how the statute was changed. And now this is the Retailers Occupation Tax Act in terms of what you are seeing on screen. By incorporating these changes on the retailer's allowance into the Retailer's Occupation Tax Act, the Use Tax Act, the Service Occupation and Use Tax Acts, any statute that incorporates these sections of the ROTA and the other acts by reference are therefore also capped. As you can see, in addition to capping the retailer's occupation tax retailer's allowance, the E911 surcharge discount has also been capped at 1,000, whereas the Illinois Telecommunications Access Corporation assessment has not been capped. So now let's talk about the nuts and bolts of what this looks like for returns that are filed on a monthly basis. So the changes overall affect taxpayers who are registered for any of these account types. The ST1, the sales and use tax and E911 surcharge return, the ST70 or aviation fuel tax, the CD1 for cannabis dispensary tax, the ART1 for automobile renting tax, the CMFT1 and the MMFT1, which are county and motor municipal fuel taxes that are administered and collected by IDOR, the ST201, the rental purchase agreement tax, the LSE1, which is a monthly vehicle leasing tax form to report ongoing receipts. And then finally, the ST556, which is the sales tax transaction return that is filed on a daily basis by vehicle dealers. We're going to focus on the ST556 last and all of the other account types first. So will taxpayers only get $1,000 per month? The taxpayer has to hit the $1,000 cap, which is based on net tax due. And obviously net tax due is based on your gross receipts. Now, we may have quarterly or annual filers, and these folks, because the statute is worded per month, would be eligible for up to $3,000 for a quarterly filer or $12,000 for an annual filer, depending on how the business does during that particular time frame. Additionally, since, as we discussed, some caps are calculated separately, if the taxpayer sells prepaid wireless tangible personal property, they would also collect the E911 and the ITAC assessment, which are capped separately. So for any of these situations, the taxpayer may be able to claim more than $1,000 per month on the ST1 or one of the other associated returns. Another return that has two different caps incorporated into one return is the CD1. The retailer's occupation tax and the excise taxes are capped separately. Now let's talk about some of the reporting changes for the returns so that they're filed properly and we reduce any bills or questions that taxpayers may have about the discount caps. So the first thing to remember is that most of our retailer's occupation tax types that are and taxes that are based on the Retailer's Occupation Tax Act are required to be filed electronically. So IDOR has worked to make changes in my tax, as well as working with our third-party software vendors through our electronic commerce division to also update their products to encode the changes to cap the discount. So whether you are using my tax to file your returns or using a third-party software provider, line 10 on the return has been capped at $1,000, or $3,000 or $12,000 for quarterly or annual filers. What I want to point out and what I will come back to is that on my tax, you're typically required to have your site registered for the account prior to filing the receipts for that location on an ST2. What we have done in late last year, going into this year, is that we have worked with our third-party software vendors to also include the 3-digit R number in the data file transmission. And if that 3-digit R number that is part of the site location code is included in the file transmission, taxpayers may include receipts for sites that are not currently registered for, and IDOR will automatically register those sites as part of the filing process. So let me repeat that again. This is the bottom bullet on this page. If you are using a third-party software vendor to file, you do not need to pre-register changing location sites in order to report destination-based retailer's occupation tax. All you need to do is include the correct changing location code for the municipality, including the 3-digit R number and the data file transmission that is sent through the third-party software vendor. We'll talk about that a little bit more as we talk about some of our other changes for the year. Part of the reason why we did this is that Illinois has approximately 1,800 changing location sites to report the sales taxes by the either incorporated or unincorporated municipalities. In Illinois, municipalities are empowered to pass their own local retailer's occupation taxes, which IDOR then collects on their behalf. Myself, my leadership team, my team, and our developers are vigorously working to make filing sales taxes in Illinois easier for every single taxpayer, whether they are a global enterprise or whether they're an individual who's trying to pay the sales tax on a vehicle they purchased. Also, keep a lookout for big improvements in my tax later this year. Now I want to talk about where the rubber hits the road for the destination-based sales tax reporting. And this is for, this change impacts approximately 20,000 Illinois taxpayers who had a physical location in Illinois, but were delivering and fulfilling sales from outside of Illinois. Previously, they were able to pay use tax based on their physical location within Illinois on any sales that were sourced from outside of Illinois. Going forward, they'll be paying destination-based retailer's occupation tax. So first, let's take a look at what has actually changed in the statute. On this slide, you can see the prior definition where they had physical presence, if they fulfilled from inventory located outside of Illinois and the selling activity occurred outside of Illinois, they only needed to collect and pay use tax, Illinois use tax. Effective 1/1/25, the definition was updated to include the definition of selling at retail, that is the key part of what the update was. The definition of selling at retail in Illinois has been updated to include retailers with a physical site in Illinois who fulfill from outside. There are a couple of carve-outs for this new requirement. One carve-out is that direct wine shippers don't meet the physical nexus for place of business definition. And then for our next bullet, there is a slight error here that is impactful. It should read pharmacy services providers or any other service provider who transfers tangible personal property as part of a sale of service. Those service providers may still need to report both destination-based ROT for any non-service ROT that is delivered in Illinois, and then for tangible personal property that is delivered as part of a sale of service, that tangible property would be reported on lines 6 and 7. So if these folks are filing on my tax, the people that now have to collect and report destination-based ROT, if these people use my tax to file, these taxpayers will be routed to site maintenance so that they can register the correct changing location, incorporated or unincorporated municipal location to their my tax account, and then those sites will appear on the ST2 for them to complete the gross receipt information by site. However, if these folks are using the third-party software providers to file, they just need to include the full location code, including the R number, in their file transmission, and they do not need to do anything else to register and report that site. When the return comes in, the site will be registered on their account automatically as part of the file transmission process. If you are a service provider and you file on my tax and you go to find that you're not able to access lines 6 and 7 in order to report your use tax, you may call or email our central registration division. Their phone number is 217-785-3707, or you may also email them at RE as in Victor, C as in Charlie, R as in Ralph, D as in dog, at illinois.gov, and let them know that you're a service provider that needs to report use tax receipts, and they will update your registration so that the lines in my tax are available to you. Now I'd like to move on and talk about the changes to the leasing statutes, where leases and rentals are now considered retail sales in Illinois effective January 1st, 2025. So first, let's take a look at the statute changes that implemented the change in definition. It's very short. On and after January 1st, the term sale includes a lease, and that is what they updated. Note here that registered property is excluded from the change, and that is because registered property had already been covered by prior statutes for the automobile renting tax. And so it was carved out from this update for January 1st. So what does this mean in terms of practical impacts on Illinois taxpayers? So for short-term rentals, you can see a list of some of the different types of business enterprises that are now impacted by this change. One key thing to note is that the change excludes sales of service or tangible personal property that is used as part of the service is not under the renter's, also known as the lessee's, control. In terms of the hourly and daily rentals, some examples of these items may include items like lawn mowers, tools, or carts that are rented from hardware stores or other equipment providers. Add-ons for car rentals that are not taxed under automobile renting tax would now fall under the retailer's occupation tax and would be subject to ROT, such as baby seats, ski racks, or navigation systems that are typically add-ons during a car rental. Now, some examples of the sales of service that are excluded are things like linen rentals, dumpster rentals, porta potty rentals, locker rentals, or storage unit rentals. Generally, these will not be considered rentals of tangible personal property. These are considered service-based rentals. The storage unit rental can be a little bit tricky depending on if it is a pod type storage unit that is delivered to the renter. That would fall under a taxable event. What I encourage you to do, one other thing to note, real property rentals like apartment leases are not included in this statute. What I want to emphasize here is that these are broad general strokes. Everything depends on the business model of the enterprise and the terms of the contract that they have signed as to whether it would be considered a service rental or a rental of just straight up rental of tangible personal property where the lessee or the renter controls the property. So I highly recommend that you consult with an attorney if you have questions about whether something should be taxable or not. Moving on to the next slide, I also wanted to include some information for various types of business enterprises in terms of reporting requirements. So for large equipment leasing companies, the sale for resale they'll need to register for the ST1 in order to report sale for resale to leasing companies. For folks that rent trailers, there are some additional requirements in terms of additional accounts they may need to report both the initial trailer rental and then ongoing monthly rental payments if it is a long-term rental. And then there is an important exemption on the new statute for collecting ROT on rentals or leases, which is if the tangible personal property is subject to another local lease transaction tax, such as in Chicago, it would be exempt from the state tax as long as it's properly due. So now let's move on. We're going to circle back to the discount cap change and particularly how this has impacted vehicle dealers. First, we'll start with looking at the statute, where again, it just says beginning with returns due on or after January 1st, the discount shall not exceed $1,000 per month. Key thing to note here is that the $1,000 cap is across all of the transaction returns received during that month. It is based on the receive date of that initial transaction. The problem, of course, is that how will the dealers know when they're close to or have hit the cap as they file the returns throughout the month? They may transmit returns that are not processed in the same order as they have claimed the discount. They may use both my tax and third-party filers to file returns and claim discounts. So there might be delay in tracking the total amount of claim discount there once you get close to the cap. And from a high-level perspective, neither dealers nor the department really wants the dealers to be overclaiming their discount, because then they would get billed. And it would result in a lot of excess billing, both for the dealers and for IDOR, and potentially penalty and interest claims. Ooh, what did I do? I don't know what I did. I turned off the screen. Ah, here we go. My apologies, I hit the wrong button. So moving on to the next slide, IDOR wanted to make it easy for the vehicle dealers to be able to claim the return and make sure that they did not go over. This slide walks through the nuts and bolts of that process. Basically, IDOR will calculate the discount on behalf of the vehicle dealers. The dealers will pay that full tax amount due. We will reconcile all of the returns for the month. We will keep those discount credit refunds separate from any other credit rolls within the account. And then we will create the refund and issue it to the vehicle dealers on a monthly basis. One thing to note here is that the refund will be issued from the Illinois Comptroller, whereas the refund letter will come from IDOR, which details all of the returns that have been included as part of that $1,000 discount refund. Also, just to reinforce the process for the SD 556 discount refunds, it does take approximately 60 days for us to get through that reconciliation process. We are in the process of finalizing that first discount refund transmission as we speak. We are hoping to get it out within the next 5 business days. And basically, once we get this process going, it will be a monthly refund process for the vehicle dealers based on the returns filed during the discount refund month. It's always going to be about 60 days in arrears.